Welcome back to the Deep Dive. Today, we are on what I'd call a critical mission. We're assessing the true state of recovery for DIALOG Group BHD, one of the region's most important energy infrastructure players. If you were with us for our last deep dive on their Q4 FY2025 results, you'll know the stakes are incredibly high. That was the one where we looked at their strategy right after they posted their first loss in, a quarter of a century? We called it, Is DIALOG Group Recovering?
And this Q1 FY2026 report, for the 3 months ending September 30th, 2025, this is really the first definitive answer to that question. FY2025 was defined by those huge one-off impairments, all that volatility.
Right.
Now, finally, we get to see the clean slate, the real operational picture after all those write-offs.
So our mission today is to go way beyond the headlines. We need to figure out if this operational bounce back is, structural. Has management really protected the balance sheet? And critically, how are they going to fund this massive pipeline of growth they keep talking about? We're going to unpack the latest report, really scrutinize the quality of their profit, and tackle the 10 biggest questions you, our listeners, sent in. But before we dive into this...
Well, it's an absolute fire hose of data we have for you. Please, help us keep doing this kind of in-depth analysis. If you're getting value from these deep dives, just take a second right now, click like on this video, and hit that subscribe button. It honestly makes all the difference.
Okay, so for the structure today, we'll start with the high-level Q1 numbers. Then we're going to jump straight into this paradox of revenue growth versus a lag in net profit. After that, we'll dedicate real time to each of the 3 core segments: Midstream, Upstream, and Downstream.
And we have to spend some time on their debt structure. That's a big one.
Absolutely. And then we'll wrap it all up with our long-term assessment, the Financial Moat Scorecard. Okay, let's get right into it. These figures for Q1 FY2026 versus the same period last year, they really present a classic dilemma for an investor. You've got growth on the top line, but some friction on the bottom line. Let's start with revenue. It came in at a pretty solid $657 million.
Yep.
That's up about 3.6% year over year. And the report says that's mostly from better performance in both their Malaysian and international operations, which, signals demand is still pretty healthy.
And that's the first bit of good news, but like you said, the bottom line is where things get a bit fuzzy. The net profit after tax, or NPAT, landed at RM146.2 million.
Which is actually down.
It's slightly down, yeah. It's 1.6% lower than the RM148.6 million they reported in Q1 of last year. And the EPS, the earnings per share, it followed that trend, dipped from 2.68 cents down to 2.48 cents.
So, okay, revenue is growing, but the net profit is shrinking, even if it's just a little bit. That alone kind of complicates the whole recovery story.
Yeah.
But this is where it gets really interesting, where we have to look for the true health of the business.
You're talking about the operating profit after tax, or OPA.
Exactly.
Okay, this is the metric. This is the one that tells you about operational health because it strips out all the noise, the one-off charges, any non-operational stuff. It just shows you how the core assets are performing.
And the number is staggering.
It is. The sources show that the group's operating profit after tax just soared by a massive 175% in Q1. It hit RM 85 million compared to just RM 30.9 million in the same quarter last year. So what that tells us is that the core operating efficiency post-impairment has dramatically improved.
175% jump in core operating profit. That suggests the business, after all those write-offs, is running way leaner, way more profitably than it was even during the recovery last year. And this brings us right to the central conflict of the quarter. It's our first investor question. So the question is this: why did this incredible 175% OPA growth result in only a -1.6% NPA day? How is this operational strength actually going to translate to shareholder profit if you have these non-operational things dragging it down?
This gap, this is the textbook definition of a quality of earnings issue. The financial reports basically synthesize the answer for us. The operational recovery is absolutely confirmed by that OPAT number. But these external non-operational factors are masking the true profit growth for shareholders.
And the biggest culprit is?
It's the reduced profit contribution from their joint ventures and associates. And digging into that, what was the problem inside the JVs? It was unrealized foreign exchange movement.
The FX issue
Again, so to put it in plain terms for you, the company's storage terminals are performing better. They're making more cash from their operations. That's the 175% OPAT jump. But because of accounting rules and how they have to value their foreign currency assets, especially in big joint ventures like PDT, when the Malaysian ringgit strengthens or weakens quickly, they have to book a non-cash, a paper loss.
Right. So no actual cash is lost, but it hits the profit and loss statement.
Exactly. This unrealized loss just suppresses the reported profit from their JVs, and that directly drags the final net profit figure down, even though their operating cash flows were fantastic.
That recurring FX issue is so frustrating for investors, especially since the Pengerang Deep Water Terminals are structured as these huge JVs. It was a big part of that Q2 FY 2025 loss too. Which leads us straight to question number 2. Given this large JV investment, what specific hedging or risk strategies are they using to address these persistent unrealized FX losses that keep hitting the net profit?
Well, what's concerning here isn't just that there's foreign exchange volatility. I mean, that's expected for any company with international assets. It's the magnitude and the persistence of the impact quarter after quarter.
So they are hedging, right?
Oh, for sure. The company uses tools like forward foreign exchange contracts. But the source material seems to imply that these just don't fully cover the exposure, especially not for these large, long-term, non-cash balance sheet translations of foreign currency balances within the JVs.
So it's a structural problem.
It is. If I were playing devil's advocate with management, I'd ask, if the core business is so strong, why haven't you put a more robust internal hedging policy in place? Or some kind of operational isolation strategy to protect these high-quality recurring JV earnings from all this short-term currency noise?
Right. The ideal would be that 175% operational strength flows straight to the bottom line.
Exactly. And this consistent FX drag just signals a leak in the financial structure that really needs to be plugged.
That's a great point. It's a structural accounting vulnerability, not an operational failure. Okay, let's move to the other non-operational factor that's been affecting the bottom line. The tax rate. It's been all over the place.
It's been a real roller coaster, and that's driven by that huge loss they booked back in Q2 of FY 2025. That loss just created some really complicated tax dynamics.
Which brings us to investor question 3. What kind of sustained effective tax rate, or ETR, should investors expect? Because we've seen a lot of volatility, including a really low rate in Q1 FY2026 because of tax losses and foreign rates.
Right, so during Q1, the effective tax rate was relatively low, and this volatility, it's really a hangover from the last fiscal year. When the company reported that massive loss before tax in Q2 FY 2025, they generated substantial tax losses in certain subsidiaries.
Okay, and those can be carried forward.
Exactly. They can be carried forward to offset future taxable profits. So what you have is a situation where the individual profitable subsidiaries in Malaysia are getting taxed at the standard 24% statutory rate, but the overall group ETR looks really unpredictable because the group is offsetting new profits with those old accumulated tax losses.
So what's the key takeaway for an investor looking at this?
The key insight is to look for stability in the current tax expense line going forward. That reflects the actual cash tax they're paying on current profits. Eventually, the overall ETR will normalize, probably back towards that 24% rate, maybe a little lower depending on foreign earnings once those old tax losses are all used up. So paradoxically, the low ETR right now is just a temporary side effect of them clearing out all that financial wreckage.
Okay, that makes sense. Let's shift gears now. Let's move to the absolute core of Dialog's value, its economic moat. The midstream business. This segment was the rock, the unwavering anchor through all the trauma of FY 2025.
This is where the company truly shines. Throughout Q1 FY 2026, just like last year, the midstream operation has consistently reported better performance and increased earnings. It's just a textbook example of a durable, high-quality infrastructure asset.
What gives it that resilience? I mean, it almost sounds too good to be true, operating above all the volatility you see in the broader energy market.
It comes down to two fundamental drivers. First, they have incredibly high operational efficiency, which leads to higher tank storage occupancy. The reports consistently show it over 90% utilization. That's fantastic.
Okay.
And second, the market pricing is robust, which supports higher tariff rates. They're hovering around $6 to $6.50 per cubic meter on the spot market. You combine those two things, and you get predictable cash flow. It's a powerful buffer against commodity swings. This income stream, it funds almost everything else the group does.
And that inherent strength is clearly why management is so focused on expanding here, especially at the Pengerang Deep Water Terminals, or PDT. It's all about that long-term, contracted, recurring income.
And the expansion plans just confirm that commitment. The latest, and I would argue the most significant catalyst, is the PDT Phase 3 expansion. This was announced in November 2025. It's a huge move into the next generation of energy storage.
And it's locked in with a big name.
It is. It's locked in by a conditional long-term service agreement, an LTSA, with BP Singapore. This is the kind of structure you absolutely want to see. You have a guaranteed long-term customer before you even break ground. The agreement will add a substantial 614,000 cubic meters of tank capacity.
You know, what really stands out to me is the dual focus of that capacity. It's for refined petroleum products, sure, but also for biofuels. They're not just building for today. They're clearly future-proofing this terminal business.
Precisely. It's a strategic bridge to the future. The completion for this huge expansion is expected in mid-2028. And you have to note the internal synergy here. The entire scope of work, the engineering, procurement, construction, pre-commissioning, the EPCC, it's all going to be done by a wholly owned DIALOG subsidiary.
So that gives stable, controlled work for the downstream segment.
Exactly. High-margin internal work, which perfectly compensates for their new cautious approach to bidding on external projects.
And that brings us right to investor question 5, which is all about funding. How do they pay for these huge multi-year commitments? The question is, how much of their Sukuk or total capital is earmarked for this 614K cubic meter BP LTSA expansion, which is due in mid-2028?
Well, the company rarely breaks down its capital expenditure item by item against specific Sukuk tranches. But we know a project of this scale, running through 2028, is going to be a major consumer of capital. We're talking hundreds of millions of ringgit over the next 3 years.
And where will that come from?
It'll be a mix. It'll come from that robust, internally generated operating cash flow, which we've established is very strong. And they could also draw down on the remaining capacity they have under their existing RM3 billion Sukuk program. But the key takeaway here isn't the specific source of the cash. It's the quality of the investment. An LTSA with BP means that revenue is guaranteed for many, many years. That significantly lowers the investment risk compared to just building it and hoping someone will come.
Let's dive a bit deeper into this sustainable storage focus, because there's another major project here. It really reinforces this idea that it's a core strategic pivot for them.
Absolutely. You have to look at the PT2SB TUA. This is a 25-year, long-term take-or-pay terminal usage agreement. It was signed by the joint venture Pengerang Terminals 2, SDN, BHD, with a company called Pengerang Biorefinery SDN, BHD, or PBSB.
25 years. I mean, that is an extraordinary lock-in period. That's way longer than typical storage agreements. And it's specifically for sustainable and renewable products.
Yes. It covers the development of 272,000 cubic meters of storage dedicated just to low-carbon fuels. The total investment cost for this part of the expansion is around a hefty $330 million. And on top of that, you have the Langsat 3 terminal expansion, which is also moving forward. That's adding another 150,000 cubic meters of capacity by September 2026, with a big chunk of it dedicated to a company called EcoSeries Limited. The message from management is crystal clear. The future of their moat is in green storage infrastructure.
Okay, but this forces us to address investor skepticism head-on. The painful lesson from FY2025 was that their diversification into specialty chemicals and RPT was very costly. It resulted in RM134.7 million in write-offs. So, investors are right to be cautious about any new big-ticket ventures, even if they're labeled green. This leads to question 6. After the RPDT and chemical failures, how is this $330 million PT2SB PBSB 25-year TUA for sustainable storage protected from market and commitment risk?
This is where we have to draw a very sharp line between the failures of the past and the strategy of today. The previous write-offs were in manufacturing. The malic acid plant, the RPE joint venture. Those assets were exposed to volatile market input costs and really unpredictable demand for the final manufactured product. They were diversification plays completely outside of Dialog's core infrastructure expertise, and they failed because of market risk.
So this is different.
This is completely different. These new storage projects, like the $330 million deal, are a pure infrastructure play. The protection mechanism is that 25-year long-term take-or-pay TUA. Take-or-pay means the counterparty, PBSB, is contractually obligated to pay the tariff for that storage capacity for 25 years.
Regardless of whether they even use it.
Exactly. Regardless of if they use the storage or what the price of biofuel is on the spot market. It locks in the revenue for 2.5 decades, and it completely isolates Dialog from market price and demand risk. This shows that management learned a very expensive lesson from FY2025. Stick to your core competency, which is owning resilient, contracted infrastructure.
That clarity on the risk mitigation is so important. They're diversifying the product being stored, but not the business model.
That's the perfect way to put it.
Okay, now we have to address the segments that caused the most operational pain last year. Let's start with Upstream, which suffered from pricing and allocation issues, and then Downstream, which took the hit from those massive write-offs and the difficult lump sum EPCC contracts.
Right, so let's start with Upstream. In Q1 FY 2026, its contribution was lower. This was partly due to just generally lower realized oil prices compared to the peaks we saw in the previous year. But the really critical factor noted in the sources was a reduced crude oil allocation.
Explain that for our listeners. What does reduced allocation actually mean in practice?
Sure. So upstream operations often work under what are called production sharing contracts, or PSCs, which are managed by national oil companies like Petronas. These allocations can change for a lot of reasons. Maybe there's operational maintenance, or a field is maturing, or there are regulatory decisions that prioritize specific national needs. This instability in the volume really underscores the inherent commodity and regulatory risk in the upstream segment.
And that instability demands they proactively invest to counter it. So what's the plan to combat this volume risk? That's our investor question number 8. How will the development of the Barham Jr. field mitigate the current profit reduction in upstream, which is due to this reduced crude allocation and lower oil prices?
The strategy is actually pretty simple. If your allocation on existing fields is shrinking, you have to bring new fields online to replace that volume. So the development of new production assets like the Barham Jr. cluster, which is a 70.30 JV that started in January 2025, and the accelerated pre-development studies for the RAJA and New Tiara cluster are absolutely crucial for stabilizing their volume.
So it's a numbers game.
It is. These new assets are designed to stabilize and hopefully increase the group's total production volume as they come online, offsetting the reduced allocation on older fields. It's an investment strategy designed specifically to mitigate that regulatory and natural decline risk. It proves the segment is investing its way towards future stability.
Okay, let's move to Downstream. This segment needed the biggest governance reset after the RM134.7 million in failures and all the headaches from those prior EPCC cost overruns. We saw some immediate cost optimization in Q4 last year. What's the new long-term discipline here?
The new approach for Downstream is very focused and I would say defensive. They are taking a cautious and selective approach to bidding for lump sum EPCC contracts, and that's key. Lump sum contracts carry the highest risk because the contractor, DIALOG, has to bear the burden of all the cost overruns from inflation, material shortages, you name it. This strategic retreat really signals management has learned its lesson about risk discipline.
So instead of chasing that volatile external revenue, they're prioritizing their own in-house projects, like doing the EPCC work for their internal PDT expansions we just talked about. But that shift has to have an impact on the top line, doesn't it? Which is investor question 9. Can you quantify the expected revenue drop in FY26 from being so selective on EPCC bids, and how will these internal PDT projects compensate for that?
Management hasn't provided specific forward guidance on the exact revenue reduction from external bids, but the strategic trade-off here is clearly about quality versus quantity. They are consciously sacrificing that volatile revenue from external lump sum projects revenue that carries a really high risk of low or even negative margins for more stable, controlled margins from their internal capital expansion work.
So it's a margin play.
It's entirely a margin play. For example, taking on the EPCC for the BP LTSA expansion or the construction parts of their RM 250 million fabrication facilities. This compensation strategy trades these large, risky revenue streams for smaller, guaranteed, higher quality profit streams. It's the definition of focusing on profit quality and risk discipline over just chasing top-line growth.
And this disciplined approach seems like the most tangible evidence of improved governance, which is vital after the capital destruction that happened. So, investor question 10. What fundamental changes were made to investment governance after that RM 90.7 million chemical write-off and the RPET impairment to prevent these kinds of capital losses from happening again?
The changes are, I would say, fundamental and structural. The decision itself to immediately discontinue the malic acid project and cease the RPEKV, that is the change. Previously, the company had a sort of threshold that allowed diversification into these manufacturing ventures that were adjacent to their core business, but it required them to expose themselves to market price volatility.
And the new threshold?
The new governance threshold is now demonstrably higher. It seems that all major capital expenditure must now align with their core competency of owning or servicing long-term contracted infrastructure. This entire strategic pivot back towards contracted low-carbon storage signifies a fundamental change in their risk assessment for any non-core diversification. Management learned that their competitive advantage is in logistics and infrastructure, not in manufacturing specialty goods. The governance change is that strategic redirection of capital away from high-risk ventures and back to their core moat.
Okay, let's talk about the balance sheet. Despite all the turbulence of FY 2025, we've established the group's core operations are still very cash generative. They reported substantial net cash from operations and had a healthy cash balance of RM 1.5 billion as of March 31st, 2025. That cash resilience is their lifeline.
That cash generation is the absolute bedrock of the business, yes. But we have to spend some real time dissecting a potential red flag that was identified in the sources regarding the balance sheet, specifically a massive reclassification of their bank borrowings that affects their refinancing risk.
Okay, lay that out for us.
Let's look at the movement in their debt structure between June 2024 and March 2025. Their non-current bank borrowings, that's long-term debt due after 1 year, it decreased sharply. It went from over RM 1 billion down to a much lower RM 220.4 million.
That's a huge drop in the long-term debt column. So that must mean the obligation just shifted over to current liabilities.
Precisely. Their current bank borrowings debt that's repayable within the next year, it soared to RM 865.5 million as of March 31st, 2025. That's up from just RM 127.7 million 9 months earlier. This reclassification means a huge proportion of their prior long-term debt is now due, or at least needs refinancing, within the next 12 months.
Let me play devil's advocate here. Does this mean the company needs to find almost R1 billion in cash in the next year? Or is this just an accounting requirement? What's the real-world cash pressure this creates?
That is the critical distinction. Under standard financial reporting rules, any long-term loan facility that's maturing or scheduled for renewal within 12 months must be reclassified as a current liability, even if the company fully intends to just roll it over and refinance it. So, while their overall debt-to-equity ratio is still conservative, around 0.4, the practical implication is that management faces significant refinancing risk.
Meaning they have to get it done.
They have to successfully negotiate the rollover of nearly RM 900 million in debt in a tight time frame. That requires robust cash planning and, frankly, favorable market conditions. It's an execution risk, not an immediate liquidity crisis, but it definitely increases the pressure on their finance team.
And that need for strategic capital management ties into their existing long-term financing, specifically the Sukuk. This is investor question 4. Can you detail the allocation of the RM 500 million senior Sukuk proceeds? Is it in their cash balance, PP&E, their upstream commitments of over $1 billion, or maybe future M&A?
Right, so the RM 500 million senior Sukuk Wakala was issued back in January 2022. For listeners who might not be familiar, a Sukuk is basically a Sharia-compliant bond. Unlike a conventional bond that represents a debt obligation, a Sukuk represents an investor's fractional ownership in tangible assets or specific business activities, in Dialog's case, tied to their infrastructure projects.
And the proceeds.
The proceeds from this kind of long-term financing are typically used for major long-term capital expenditures, things like property, plant and equipment, intangibles, and especially joint venture investments like PDT. While the company doesn't issue a line-item use of proceeds for this specific issuance years later, we know the pressure is immense because of their future commitment.
How immense?
Well, the commitments of the group for the upstream business alone stand at a substantial RM 1.03 billion as of June 30, 2025. So the Sukuk proceeds, combined with the successful management of that current debt reclassification we just talked about, are essential to ensure they have the financial headroom to fund these large, multi-year strategic commitments without undue refinancing stress. The capital is there, but the planning has to be impeccable.
Okay, we've seen operational recovery, strategic resets, complex financial movements. Let's bring it all together now by evaluating Dialog's competitive strength with our financial moat scorecard. We're assessing how defensible their business model is against competitors.
We are assigning Dialog a financial moat score of 8 out of 10. We're rating it as a strong, narrow moat.
Strong, but still narrow.
Yeah.
Okay, let's dissect that. Let's start with the strength, the part that gets it the 9 out of 10 rating.
The high score is entirely because of the midstream segment. The tank, terminal business, PDT, and Langsat, it benefits from these classic, powerful moat characteristics. High barriers to entry. I mean, we are talking about billions in capital cost, specialized engineering expertise, and years of regulatory approvals to build a rival facility. Plus, their location in Pengerang is so strategically crucial, it secures them an indispensable spot in global shipping choke points.
And the operations reinforce that.
Absolutely. The consistently high occupancy rates and the growth they're seeing through these long-term recurring revenue contracts, especially those new 25-year take-or-pay agreements, that provides a robust, defensible cash flow buffer against any market volatility. This core infrastructure business is exceptionally well protected, and management is actively reinforcing it.
Okay, so if the Midstream segment is a 9 out of 10, what keeps the overall score at an 8? Where's the narrowness coming from?
That's the offsetting factor. The moat is narrow because it is primarily focused on that one infrastructure segment. The volatility, the cost overruns, the impairments of FY 2025. They all confirm that the downstream EPCC business and the upstream commodity business are far more competitive and carry much higher risk. The company is trying to broaden the moat by securing those 25-year TUAs for low-carbon fuel storage, extending their competency into new energy markets. But until that new revenue fully stabilizes, the moat remains narrow, focused squarely on their contracted terminals.
And to reinforce that PDT hub status, that ecosystem, we need to touch on one final major long-term project that isn't just about storage, the Air Separation Unit joint venture. This is our investor question 7. What are the key milestones and completion targets for the LNG-driven Air Separation Unit, or ASUJV in PDT? The target was end 2026.
Right. So DIALOG entered into this really important joint venture with Petronas Gas Berhad for this LNG-driven ASU facility within Pengerang. And the sources confirm that work on the strategic facility has commenced. The ASU will produce these high-purity industrial gases, nitrogen, oxygen, and argon, with a combined capacity of 612 tons per day.
So this is about more than just revenue.
It's about ecosystem value. It dramatically enhances the PDT hub's overall capabilities and makes it way more attractive to the downstream petrochemical clients located in the Pengerang Integrated Petroleum Complex who need these gases for refining and processing. While the Q1 FY 2026 report didn't give a new specific completion date, the fact that work has started confirms they're executing on their strategic plan, which previously targeted completion around the end of 2026. This ASU facility just strengthens that industrial integration and makes PDT even more indispensable.
Okay. We have spent a significant amount of time today delving into DIALOG Group's Q1 FY 2026 performance, using the volatility of FY 2025 as our backdrop. Let's distill the most critical takeaways for you, the long-term learner. First, the core operations are undeniably healthy. That 175% surge in operational profit confirms the underlying business has fundamentally reset and is running very efficiently. However, this strength is being masked by non-operational FX volatility in their joint ventures, a quality of earnings issue that needs better structural management.
Second, the midstream moat is actively being fortified and future-proofed. The commitment to these massive, long-term contracted assets like the BP Singapore 614K cubic meter expansion and that 25-year take-or-pay TUA for low-carbon storage, it validates their low-risk infrastructure strategy. They are expanding the moat into the future of energy, but they're retaining the contracted nature of their revenue.
And third, management has executed a decisive strategic pivot in their downstream segment. They're permanently shifting away from high-risk, non-core manufacturing and those volatile external lump-sum EPCC contracts. Their focus now is on high-control, profitable internal EPCC projects, prioritizing risk discipline over simple top-line growth.
And finally, DIALOG has successfully cleared the bulk of the financial wreckage of FY 2025. They've shown real operational strength in this quarter, despite that financial pressure from the RM 865 million debt reclassification. The path of recovery is confirmed by those OPAT figures. But the real question for you to mull over is not simply if they are recovering, I think the data confirms that they are, but whether this new disciplined approach to capital allocation and the aggressive risk-mitigated shift into secure low-carbon storage signals a fundamental reinvention of the company's identity. Is this strategic pivot necessary, and is it robust enough to ensure their moat remains relevant for the next 2 decades of the energy transition? That strategic evolution is the path we're going to continue to monitor.
A sincere thank you for joining us for this in-depth look at DIALOG Group. We really hope this deep dive provided you with the clarity you needed to interpret this complex report. And please, if you valued this analysis, remember to like this video, comment below with your own thoughts on that balance between recovery and reinvention. We genuinely want to hear your perspective, and subscribe for our future deep dives. We will see you next time.